Today I will give you a basic understanding on mutual funds. Now, what is a mutual fund? Mutual fund is a pool. It's a pooling of money from investors to buy stocks, bonds, and other financial instruments by an investment company for a predetermined investment objective. So, the predetermined objective could be to buy into equities. It could be into debt products. Now, the investors own a share of the fund proportionate to the amount of their investment divided by the total value of the fund. Now, how did mutual funds come into being? I mean, the basic premise on which they came was that it was developed to give small investors access to different asset classes through professional management. What are the advantages of mutual funds? First of all, diversification into different uh, kind of products, or even if you look at equities, it is diversifying across a lot of stocks and shares. I mean, somebody who wants to invest, say, 1,000 rupees or 5,000 rupees, can diversify that holding in equities through, say, 20 or 30 or 40 stocks. So that helps uh, people with small investments to diversify. Now, professional management, as you all know, mutual funds, they are largely managed by uh, fund manager or asset managers who are professionals who day in and day out are monitoring the markets. Then minimal transaction costs, uh, currently a maximum of 2 to 2.5% expense ratio is charged. So by paying a very small amount of money, you can actually try and get professional services in terms of managing your money. Liquidity, again, excluding exit load, uh, it's very easy to really buy and sell mutual funds. They are And lastly, tax savings. This specifically is relating to ELSS or equity linked savings schemes, through which you can again save taxes. The other part with tax is that uh, we see that this is much more in terms of much better in terms of tax compliance as compared to a lot of other asset classes that we have discussed in another presentation. Now, what are the disadvantages of mutual funds? Now, primarily would be a risk of lower than market performance. Now, although we are depending on professional services, there is every chance that there is every possibility that returns are not as per expectation. Mutual funds are subject to both market and stock related risks, particularly in concentrated portfolios. Now, over here, we generally see that, in terms of defaults, in case of debt papers, we could see a sharp fall in our returns. Also, in terms of stocks, if there is some bad news which comes, and we could see a sharp decline in stock prices, that again could take a hit as far as our returns are concerned. So there may be a lock-in period exit load if redeemed within a specified period. Now, as far as tax saving investments are concerned, ELSS, they have a lock-in of 3 years, and exit load again for most equity funds, the exit load of 1 year. For debt funds, the shorter the maturity, unlikely to have any exit loads for liquid funds. And as the tenure goes up to mid-term funds, long-term funds, uh, again we generally see 3 months, 6 months, 1 year, and maybe in some cases even up to 2 years exit load being charged by the fund. What are the different costs of a mutual fund? One would be the entry and exit load. Now most funds now do not have any entry loads, so it's just exit loads which are there, which I've just discussed. The other would be the fund management fees, which the fund manager charges, fund expenses, and the broker commission. This in general is about half a percent, maybe 20 paisa to half a percent for the debt funds, and it could go up to 2 to 2.5% inclusive of all these for equity funds. Now over here again, I want to mention that uh, if you invest in direct schemes instead of regular schemes, then you don't have to pay some fund expenses of broker commission. So generally, we see that the uh, costs are lower by about 70-80 bips or maybe even 100 bips. What are the different types of mutual funds? Uh, Firstly, would be equity funds. Equity invest in stocks, debt funds, investing in a lot of commercial papers, securities, government securities. It could be corporate bonds, uh, investing in debt funds. Balanced funds again would be a mix of equity and debt. Within balanced, we would be having a aggressive, hybrid, or defensive one, depending on how much equity and how much debt exposure that you're taking. Yeah, ETFs and index funds again, it could be gold ETFs following gold prices, or it could be any kind of index like the Nifty or the Sensex. So a fund which mirrors the portfolio of the index would be index funds. Again, the two types of funds, open-ended funds, wherein you would be able to invest or put in money at any point of time. Close-ended funds generally, they collect the money, and after that do not take any fresh subscriptions, and so they remain closed till they are redeemed or matured. What are the different types of plans that are there? uh, One would be the growth plan, wherein there is no dividend payout, and your funds would just accumulate without over a period of time. Dividend plans would be paying out regular dividends. It could be there was a time where a lot of funds were paying out monthly dividends, especially in their balance category. It could be quarterly or even yearly dividend payouts. Direct plans, again, I've just explained, where you don't go through a broker, you don't pay commission, you just invest directly with the fund house. They are direct plans. They generally the expense ratio for direct plans is slightly lower than the regular plans, normal plans. What are the different types of equity funds? Uh, there would be diversified funds which invest in all types of equities. It could be large cap, mid caps, small caps, diversified across sectors. Sectoral funds would invest largely in a particular sector. It could be uh, banking and PSU fund. It could be uh, something like a infrastructure fund, a pharma fund, or it could be a technology fund investing in particular sectors. ELSS again have explained tax saving mutual funds and funds of funds, which are basically investing in other funds. Now, the types of debt funds would be short-term debt funds and long-term debt funds. Again, you would be having tenures. The most short-term would be overnight funds and then liquid funds. Overnight funds, as the name suggests, extremely short-term, safe. Liquid funds would be up to 90 days. Then you would be having ultra short term, then mid term, and then you would be having long term funds which would be in excess of 1 year. FMPs again would be close ended fixed maturity plans having a fixed tenure of maturity. This is just a basic chart about long term debt funds and FMPs versus FDs. Now, debt funds could be returning depending on when you are investing, what type. Uh, there are two types of funds: accrual and duration funds. So, depending on what type of funds you are investing, it could be credit risk, it could be uh, corporate bond funds. So, whatever funds that you're investing in, depending on that, it could be getting about 10 to 12% return. FMPs generally, when again, all this would depend on the interest rate scenario. So you could be getting currently maybe around 8.5, 9% interest. Bank FDs again around 7% for senior citizens. Now bank FD rates are coming down, so it could be below 7% also in some cases. Safety, as far as safety is concerned, debt funds are reasonably secure, but returns are not guaranteed. FMPs again return adjusted to inflation, while for bank FDs it is fixed. Uh, the withdrawal, again I have said, depending on the type of funds, your exit load would be applicable. FMPs, again, fixed maturity, withdrawal not possible. Maybe if it is traded in the markets, you can sell it off. It's highly liquid. Uh, as far as liquidity is concerned, all of them, debt funds, FMPs, they can be sold in the open markets. But again, as far as FMPs are concerned, I think liquidity is a concern. You might not get buyers all the time. Again, liquid funds versus savings accounts, just a basic comparison. I feel liquid funds are a very good option or an alternative for savings funds. If you want to park your money for 15 days, a month, or 2 months, I think we could easily be getting around 6.5, 7%, or maybe at certain times even above 7% returns. And they're extremely liquid. You can just withdraw your money at 1 day's notice. Uh, then the other thing is with liquid funds, it can be used to switch equity funds and then to switch to equity funds and gives you the benefit of both. You can get 7% as long as your money is there in the fund and you keep transferring through STPs into equities. What are balanced funds? Balanced funds, as I explained, a mix of debt and equity at a predetermined ratio, could be 80-20, 70-30. But in general, balanced funds debt is not less than 60%. Now, ETFs or index funds, again explained previously, index fund would be mirroring the exact index. ETFs would, for example, would be gold ETF. What is the NAV? NAV is basically a mutual fund's price per share. The per share rupee amount is calculated by dividing the total value of the security less any liabilities, the number of funds or shares that it has. And NAV is computed on a daily basis on the closing market prices. Now, all the buy and sell orders are processed at the NAV for all securities. For example, if you have 40 crores in a fund and you have 1 crore units, so the NAV would be 40 by 1, which would be rupees 40. Now, talking about SIPs, this is a very important tool to iron out the fluctuation of the market and avoid timing the market. I mean, we all know the market keeps going up and down, so it's very difficult to really understand what would be a good time to invest. Uh, so today, in terms of lump sum, you put in all your money at a certain level, and then the markets fall, you would be at a loss. So to iron out this, you know. You can do an SIP which helps in gradual accumulation of units over a period of time. This is perfect tool for salaried people who can do a monthly SIP. Now, this works well in uncertainty and in a volatile market. And lastly, I think a combination of a SIP, which is systematic investment plan, systematic transfer plan, which I was previously mentioning, from maybe liquid fund to equity fund, and a SWP, which is basically systematic withdrawal plan, which works very well for senior citizens who could be wanting regular income and withdrawing a specific amount of money every month or every quarter. So that way you can have a SWP. It's a perfect tool for wealth creation because it's disciplined investing, rupee cost averaging, which I will mention in the following slides, compounded returns, and you can always start with a small amount, 500 rupees to 1000 rupees every month. Again, forced savings, once you give the mandate, every month automatically money will get deducted from your bank account. So it's forced to an extent. Now, SIP plus CLSs can be a good option for your retirement planning, wherein every month you can accumulate some amount in your ELSS, which helps in your tax saving for the year, and then accumulate for the long term for to build up a retirement corpus. This is just an example of how the cost averaging works. Now, there are basically two types of returns which you get uh, from your investments. One would be your capital gains. So today, if your NAV goes up from say 10 rupees to 15 rupees, you make a 50% capital gains. The other would be the dividend distribution, which will only be applicable if you are investing in a dividend option. Capital gains would largely be for growth option. For example, if Mr. Varun had invested rupees 1 lakh in an equity fund and he received a dividend of 2000, and then he therefore sells his investment 1 lakh 15,000, and his returns would be about 17%. Tax benefits on mutual funds. This would be for equity holdings. For debt funds, again, short-term capital gains, you have to hold up to 3 years. So above 3 years, you get long-term capital gains, which would be charged 10% without indexation and 20% with indexation. Every year, the government comes up with a cost inflation index. So accordingly, you can calculate your inflation, uh, cost inflation, and work out your tax liability. Suppose you invested 1 lakh, then in December 2016 and redeemed in January 2018 for 1 lakh 12,000. And the index cost according to this table would be 1 lakh 7,087 rupees. The tax payable would be 982 rupees, 20%. The same without indexation at 10% would be about 1,200 rupees. Thank you.